Hello, everyone. Good afternoon. Please confirm if I'm audible through the chat box. All right. Thank you, everyone. Hello, everyone. Good afternoon once again, and welcome to our SBR webinar day 1 for June 2026 attempt. Till now, we have finished 6 live practice sessions, and I had mentioned to you all last week itself that this is the just the end of a regular practice session, and things become more intense week by week after this. Things don't lighten up in the sense that you guys might end up panicking, thinking that this is the only practice in terms of live session, but that is not the case. Intensive revision sessions have started from this week itself. Now, today I am in the day 1 going to cover the most recent release by ACCA body, which is your pre-June 2026 mock. Okay, so there is a groups question that I'm going to cover today. And I'm going to cover ethics questions. You know, groups question is always question number 1, 100% you know this. And ethics is also 100% you know that it's a question number 2 itself. So both we will cover. And these are both coming from your pre-mock 2026. The recent release by the ACCA body. Question number 3 and 4 we will cover tomorrow. Okay. So I would want you all to go to your practice platform and open this question paper. Open the June pre-mock 2026. Just in case someone doesn't know how to open, I will guide you all. While I'm opening, you all can have a look at it. So I'm going to share my screen now. You will enter your practice platform. You will have an option if you go and click, even on Google, if you just go and type ACCA practice papers or ACCA past papers, you will get a link to the ACCA Global, and they will direct you to this page for any subject, FR, SBR, any subject, okay? And you will have this login practice platform link. Once you click to the link, you will be asked to sign in. And once you sign in, you will have a page where you will be asked to click browse available exams. Once you click browse available exams, you have to select your paper, which is SBR and the international variant. The moment you do this, SBR and international variant, many papers will be flashing on your screen. What you have to select is a pre-June 2026 mock exam, assign. Okay, pre-June 2026 mock exam, assign. For me, I've already assigned, so I'm going to go to my view of assignments and check this paper. And pre-June 2026 mock exam, you might have start, I have a resume. Okay. Okay, so I would want to go to your navigator and be on your question number 1, which is called Rome Company. Go to your navigator and come to question number 1, which is a Rome Company. By the way, anyone who is not my regular student and who has just joined the session just for the webinar, then y'all can take a quick screenshot of the contact number of VIFHE just in case y'all have any queries regarding the enrollment, crash course, reset course, anything. Y'all can contact these numbers that have been provided on the screen. Okay, so anyway, I'll continue. Come to your own company. Now, what I'm going to do is I have a word processor to crack this, and I also have a spreadsheet to crack this. Okay, what I'll do is, guys, I will stick to the practice platform only. I'll crack it over here only. I can go and crack it on a word sheet and a Microsoft Excel. The only advantage when I do it on a Word and a Microsoft Excel is that when you'll click the cells, you all can see the formulas. So that formula is preserved. When I do it on the spreadsheet and word processor, the way I am able to share the solution with you is in the form of screenshot. So no problem. I'll take those screenshots, I'll turn it into a Word and then a PDF, and I'll share it with you all. Okay. The only thing is you will not be able to double click and check what the formula is. But don't worry. What I'll do is wherever I'm putting a formula, in the bracket, in the open cell, I'll show you what formula I've used. So it should not be a, hiccup there. The reason why I would want to stick to the practice platform is that you all should also understand the challenges of doing anything on the practice platform. Till the time you all don't do it, you all don't see literally key in an answer, you all don't understand the challenges you will face in the exam. Okay, you need to understand that, okay, this is a word pop-up that is going to come and you're going to use it to write your answer. You're going to have a spreadsheet pop-up and you're going to use that to have your answer. The workings you're just going to be able to do at the bottom over here. Okay, and what Control X, Control V feature, copy paste feature through the mouse clicks, what all is available, only when you do it here you will know it. Okay, now without wasting much time, I'll get started. Let's start reading the question. So the first question, compulsory question, groups question. Okay. Rome Group has a number of subsidiaries. Rome prepares consolidated financial statements to 31st December each year. The directors of Rome have prepared an initial draft of the consolidated statement of financial position at 31st December 20x6. On the last day of the current accounting period, 31st December 20x6, Rome acquired a 50% interest in Italy. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Details of the investment, NCI and net assets of Italy, details of a provision, construction contracts and grant relating to Rome's warehouse, the draft consolidated statement of financial position of Rome as of 31st December 20x6. So your year end is pretty much your calendar year end, okay? Now, what important information that we have gotten is that in Exhibit 1, we have an investment, okay? And above, in the above paragraph, they said that on the last day of the current accounting period, it was acquired. And how much? By 50%, okay? 50% is our interest in it, our stake in it. Now, the information should be used to answer the question requirements within your chosen response options. There is no need to refer any exhibits in answering part A of this question. When you read the introduction, you understand that when you crack the requirement A in the requirements, there's no need to read any exhibits. So it's purely from your memory of the standards. The requirement A will be. Requirement A1. Discuss in what circumstances that Rome would be correct in accounting for 50% of investment in Italy as a joint venture and how it would be accounted for in the Rome's groups of account. In what circumstances is your first question. In what circumstances you can record it as a joint venture. And second, then how it would be accounted for. So second requirement is how it would be accounted for. Okay, two requirements: in what circumstances and how it would be accounted for, and this is worth a 4 mark. Okay. Second, they're saying discuss in what circumstances, again, what circumstances that Rome would be correct in classifying the 50% investment in Italy as a subsidiary. Now look over here. See, be very clear with the requirements, because in a panic situation, you all tend to be all over the place and write extra. Some people write less. In the requirement 2, only the what is asked and how is not asked. So what you have to give is a very limited answer, that in what circumstance an entity would be recorded as a subsidiary company, and this is worth a 2 mark. So here easily in what circumstances would be worth of 2 marks, and the accounting would be worth of 2 marks, right? Split. And here only the what circumstances would be of 2 marks. The third requirement is explain how goodwill arises and how it's accounted in the group accounts. How goodwill account arises, how? And how it is accounted, meaning the accounting treatment is also asked. So in the first question, there are 2 requirements, even though it's 1 requirement, but 2 sub-requirements are there. In the second, only 1 sub-requirement is there, and in the third, 2 sub-requirements are there. The time you identify exactly what is asked, like what are the number of requirements and what is asked, when you're drafting your answer, you will not miss it. And whatever marks are there, 100% you will get that. Okay? If you have the right knowledge around it, then you'll definitely be able to apply it. Now, again, there is a note. It says there is no need to refer to any exhibits in answering part A of this question, which means that the first 3 requirements, sub-requirements that I have A1, A2, and A3, I need not read the exhibits. It's purely from memory. In what circumstance you account for as a joint venture and how do you do it? In what circumstance you do a subsidiary accounting? How is goodwill accounted for and how does it come in picture, right? All this is from memory of your standards on joint venture, on subsidiary, and on goodwill. Okay. Which also means that when you're going to do requirement A, there will be no impact in pre-populated, because if you are not going to read any exhibit, then it means there is no numbers involvement. Okay, there's no numbers involvement. And if there's no numbers involvement, the final requirement, which is on your pre-populated spreadsheet, will not be relevant to be cracked right now parallelly. Because if you guys know my approach, if the students sitting in right now in this class are my students, you all know the parallel approach that I use. That when I crack the first requirement, I will do parallelly in the pre-populated. But in this situation, that's not possible because nothing is coming from exhibit. Okay. Next one. In requirement B, using Exhibit 1, calculate the goodwill in the Rome Group accounts arising on the acquisition of Italy. So the requirement B saying using Exhibit 1, calculate the goodwill in the Rome Group of accounts arising on the acquisition. So second requirement B is now started to link with Exhibit 1. Till here, I need not read Exhibit 1. Okay. And I would want to also understand what is the final requirement, what all exhibits it's asking me to incorporate. The final requirement using the pre-populated spreadsheet response option exhibit 3 and your previous answers, which means right from the time you're doing exhibit 1, 2, 3, all of them, you will take care of your pre-populated. You will not do it at the end. You will take care of your pre-populated right from the time you attack your first exhibit, because they said previous answers as well. Okay, I'm not reading the full requirements here now. I'm not reading the full requirements, or we can read the full requirement of D at least. Adjust the spreadsheet prepared by the directors of Rome in order to prepare a correct consolidated statement of financial position as of 31st December 2026. The
Ma'am,
spreadsheet should, yeah,
I'm not able to join. Just now I joined. I'm not able to connect with you. Okay.
I didn't understand. You're not able to connect what, dear?
I'm connect with you. Just now I joined. I'm not able to
Ha,
connect with you. Parent.
you're able to listen to me?
Yes, ma'am. But
Okay, so
where
I've not,
you're teaching, where you're, which line you're
okay,
taking, and
I have not started formulating the answers, Raghavin. I'm just reading the requirements till now. Nothing else. Okay.
okay, ma'am.
Next. So I said using exhibit 2, sorry, the last requirement was the spreadsheet should consider the following: consolidation of Italy as a subsidiary and corrections to the provisions, construction costs, and grant relating to the Rome's warehouse. So now I will do the first thing first. I will cater this, which has got nothing to do with any exhibit. Then I'll move to exhibit 1. And when I move to exhibit 1, remember the parallel accounting and pre-populating. Okay. So let's start. What I'll do is I'll copy this question so that I don't remember I don't forget the requirement. Okay. Now discuss in what circumstances that Rome would be correct in accounting for a 50% investment in Italy as a joint venture, and how it would then be accounted for in the Rome groups of accounts. So for a joint venture, if you all recall the standard, what did the standard say? What did the standard say for joint venture? What should you have so that you know that there is a joint venture? Before a joint venture, there should be a joint arrangement. How do you know there is a joint arrangement? How do you know there is a joint arrangement when there is a joint control? How do you know if there is a joint control when there is unanimous agreement between the parties who have control, when there is a unanimous agreement between the parties who have control, right? So for me to say there is joint venture, first there should be a joint arrangement. Joint arrangement can be proved by joint control. Joint control can be proved by unanimous arrangement or unanimous agreement. So in line, I can quickly prove this, okay? When there is a possible, and then how do I prove joint venture? Then you know that there should be a separate entity for it. Interest should be there in the net assets, not on the individual assets and liability. So I'll go ahead with that as well. Okay. So, and by the way, one more thing, guys. I keep saying you can use the SAC, or you can use the AC also, apply, conclude also, or you can use AAA also. So state, apply, conclude. Yes, it's a nice framework. If you all have problems in formulating the answer, you can say what the standard says and then apply that to the scenario and be able to conclude it. But if you all are very good with drafting answers, then straight away hitting application, purely application will also get all the marks. Okay. But sometimes students struggle in application. They can't straight away do applications. Then stating has marks. Stating has marks. Okay. Stating meaning what? The which standard is there? That doesn't have marks. What the standard says particularly to the scenario, that has marks. Okay. So anyway, I'll continue. And I'll start right from the application part of it. Okay. So in order for an entity to be a joint venture, first there must be a joint arrangement. A joint arrangement is possible only if there is joint control. Joint control exists if there is unanimous agreement among the parties regarding the key decisions of the organization. However, a joint arrangement can either be a joint venture or a joint operation. If the entity has rights on the net assets, then rather than individual assets and liabilities, then this is an indication that joint venture exists. Also, we can see that there is another entity incorporated. There is a separate entity incorporated, Italy company. And as it's a separate entity, Rome would have right on the net assets only rather than individual assets and liabilities. And they asked us very clearly how it should be accounted for. So I'm going to cater the how, otherwise I'll lose the mark for the how, okay? Joint venture in the group accounts is recorded using equity accounting, which means initially it will be recorded at cost and it will increase by the share of Rome's profit in Italy company in the non-current asset section of group. I will just give a break between where I've started the accounting treatment. In the group, I will write not in group accounts, group financial position. To be more precise, it's the balance sheet treatment that I'm giving. In the group P&L, the share in Italy's profits will be recorded. Okay, so we were on the requirement A1. Yeah, we were in the requirement A1, and as I said that they wanted us to first write in what circumstances it's a joint venture and how to account for it. So I gave both in what circumstances and how to account for it. And this was worth a 4 marks. So definitely with a very clear cut, writing and answering the requirement of both or each of them, we can ensure that we have a 4 mark. Now we're going to go to the requirement 2, which was on in which circumstance an entity would be a subsidiary, right? And no accounting was asked, it's just in which circumstance. Can you all tell me in which circumstance an entity can be a subsidiary? Can you all tell me that, especially that mnemonic, which is important for us to be able to say that the opposite entity is a subsidiary company? Can you all give me the mnemonic in the chat box?
Significant control.
So voice is soft, guys.
Significant control.
Control, yes. You should have control over the opposite entity. You should have control over the opposite entity. By what way can we say we have control? What is that mnemonic which gives us, which tells us these are the parameters for control? What is that mnemonic, guys?
More than 51%.
PEAP. P standing for power over the entity. E standing for exposure over the variable returns over the entity, and A standing for the ability to influence or ability to exert the power or ability to exert the control. Okay. So Italy can be classified as as a subsidiary to Rome Company if Rome Company has control over Italy Company. Control can be determined if Rome Company has the following: power over Italy Company, ability to exercise the power, third, rights or exposure over the variable returns of Italy Company. Merely the acquisition percentage is not an indicator of control. The percentage along with the above factors determine the control. Okay, so I have given in what circumstance, which is just worth a 2 mark. Now, the third requirement is explain how goodwill arises and how it is accounted for in the groups. So, you know how goodwill arises. What is goodwill? If you have to say it in one line, and if you've watched my lectures correctly on this, or you have watched my lectures rather of the FR Bot Forward Knowledge, you will know what is goodwill. What is goodwill? And in which situation does the goodwill arise? Goodwill is when you pay dash. Can you all put in the chat box? Goodwill is when you pay dash. Yeah, when you pay extra above the worth of the company, when you pay the premium over the worth of the company, when you pay additional amount over the net worth of the company. Yes. So the extra, premium, excess over the net worth, above the net worth, all these are right terms. All these are right terms. Okay. Examiner will understand what you are indicating. So the third requirement. There are two things asked: how goodwill arises and how it's accounted. Okay. Goodwill arises when there is extra paid along with the non-controlling interest over the net worth of the subsidiary company. This is the premium amount paid for the subsidiary. In essence, controlling interest plus non-controlling interest. When are above the fair value of, or when are above the net worth of subsidiary company, then goodwill will arise. Now, the way it is accounted for. Okay, the way it is accounted for. Goodwill is treated like a intangible assets intangible asset in group accounts and is recorded in the non-current assets. It is evaluated for impairments annually, with impairment being recorded in the profit and loss. The goodwill, there can be no reversal of impairment on goodwill. So the accounting also I have also given in which situation goodwill will arise. But goodwill requirement was for 3 marks. So if you want to be a little more safe, you can write something additional. I'll write something on bargain purchase as well. So the above point was when the controlling interest and non-controlling interest are greater than the net worth. So I'll write when the controlling interest and non-controlling interest combined are lesser than the net worth of subsidiary, then this is treated as a bargain purchase and recorded like a gain in the profit and loss. So because it's worth a 3 mark, I'm just trying to be a little more safe and add one more. Y'all can write where the impairment will hit. It also really depends upon, see, it's worth 3 mark. Right now, I feel I've written enough to get the 3 mark. If y'all are so if you did not write on the bargain purchase, yes, you could go ahead and write in which section of the PNL. Okay, you could go ahead and write in which section of the PNL goodwill impairment would have been recorded. Now, using Exhibit 1, calculate the goodwill in Rome Group's accounts arising on the acquisition of Italy. So I'm going to calculate the goodwill. But remember, now I'm going to touch Exhibit 1 and I'm going to touch numbers. So I would want to see if pre-populated is impacted. We did this exercise. We saw that for the pre-populated requirement, it said adjust for the previous answers as well. So while I'm calculating goodwill, I'll also do adjustments in pre-populated. Okay, let's be very clear with this. Yes, Raghavina, you can write that only purchase goodwill. They're asking me groups accounts treatment, right? So for me, I'm talking about in groups accounts, definitely it's recorded. For groups accounts perspective, it's purchased only. But you can deliberately add that as a point. It does make sense and it will add mark. Okay. Now moving to the spreadsheet, because they're asking me to calculate goodwill, I need spreadsheet. So I'm going to go to Exhibit 1 and parallelly use the spreadsheets for calculations. So the best way to do this is that have the spreadsheet on the right and have the question on the left so that you can manage both. Okay, so I'm going to have this at the right, have my exhibit to the left so I can manage both. So if you can see, I can literally look at the left and type things on the right. So this is fine. This is a comfortable place. I'll increase the size a little bit. Maybe a little more. Yeah, this is good now. Okay, we are doing a goodwill calculation. So requirement B, goodwill calculation. Now, okay, they're telling me details of the investment, NCA and net assets of Italy. Italy is in fact a subsidiary of Rome, but has not been consolidated into Rome groups of accounts. See, if they're telling me Italy is a subsidiary, I don't need to do any judgment now. They told me it's subsidiary. Finish. Game. The story is ended there. I don't have to make a judgment now. I just know it's a subsidiary and it has to be accounted for as a subsidiary. But they are saying that it has not been consolidated into Rome group of accounts. So this is a problem. Not being consolidated correctly, this is a problem. And I'll have to do that correction. Okay. Acquisition accounting should have been applied. Acquisition accounting meaning when you acquire a subsidiary, you know that you have to, if you recall the rules of consolidation, cancel investment in subsidiary, cancel share capital, share premium of subsidiary, the first rule. Add goodwill, add NCI. Third rule, adjust group retained earnings, remove the pre and only have the post retained earnings, right? And also all the assets and liabilities are going to get added line by line, correct? These three rules and all the assets and liabilities. So that is your acquisition accounting. That is your acquisition accounting. Okay. Now, what has happened is they have not done this acquisition accounting, which means we need to make sure that investment is cancelled, share capital share premium of subsidiary is not there. If they did not do a consolidation, then share capital share premium must have already not been there. So it's okay. That part is correct. Investment must have not been cancelled. We'll have to cancel the investment. Add goodwill and NCI. If they did not treat it like a subsidiary, goodwill and NCI must be missing. We'll have to add it. Adjust the retained earnings to make it group retained earnings. You have to remove the pre-period retained earnings and just have the post-period retained earnings. As far as I remember, for this consolidation, they said that they had acquired the subsidiary at the last day of the accounting year. At the last day of the accounting year, which means that in the post-period, there is no profits of the subsidiary that I will take. Pre-period, all profits I shouldn't take. That should be cancelled. So if they did not consolidate it at all, then it's already not there in the picture. So no need for me to do a deliberate cancellation. It's already not there in the picture. Okay. So share capital, share premium, no need to cancel, already not there in the picture. Investment could be there, cancel it. Add goodwill, add NCI, that could be missing. Pre-group retained earnings, because already consolidation done, not there. Okay, so these three things are fine now. What about the fourth thing, adding assets and liabilities line by line? That would also not be done because they did not do acquisition accounting. So that also we'll have to do. Okay, now let's move ahead. Rome's investment in Italy has been recognized as a 25 million investment. So investment in the balance sheet must have been recorded at 25 million. We would have to remove this. Okay. Now, the consideration that Rome gave for investment in Italy comprised of a 15 million in cash, 10 million in zero coupon bonds that will be redeemed at par in 2 years' time. Relevant interest rates are 8%. Relevant interest rates are 8%. The group's policy is to measure the NCI interest as a proportion of net assets. At the date of acquisition, the net assets of Italy comprised of the following. So they have given us the book value, which means they have given us the carrying value and they have given us the fair value. At the date of acquisition, when you're taking the net assets of subsidiary, should you take the book value or should you take the fair value? What should you take? Give me quickly in the chat box. Should you take the book value or should you take the fair value? Fair value, only fair value, absolutely correct. Now, and they're saying, however, no account had yet been taking care of the deferred tax implications of the fair value adjustments. The rate of tax is 40%. You know that if there is a difference between carrying value and the fair value, we'll have to account for this difference. And this seems like a 10 and 11, 2 million difference. So there'll be a deferred tax implication on this, right? So this is also what we'll have to account for. So this is all that's been given us in the first exhibit. So let's finish our purchase, our goodwill calculation with this. So purchase consideration, add NCI, less the net assets. This is my classic formula. Okay. Purchase consideration is how much? Purchase consideration has two items. It has cash and it has bonds. So cash is 15 million. By the way, the answers are in thousands in my pre-populated. You might want to see the format of pre-populated first quickly. The spreadsheet, everything is in thousands. So if everything is in thousands, you will definitely use thousands over here. Even in your workings, you will use thousand. You can't mix. Okay? So you can't have millions at one place and thousands at the other place. So I'm going to have purchase consideration in cash recorded as 15 million. I'll take it to the right so that I can do it parallelly only. 15 million. Then you can see that I have 10 million zero coupon bonds. So if it's a 10 million zero coupon bonds and it's going to get redeemed at par, but you have been given a relevant interest rate of 8%, you cannot record these 10 million bonds at 10 million on day one. This will undergo a further adjustment. Okay, so I'll just write a working one for bonds. What will happen with bond is that you will have to bring this bond to present value. You will have to discount it by 8%. And they're saying it's getting redeemed in 2 years' time. So for 2 years, you'll have to discount it and bring it to present value. Because it's like a loan that you are having in your books, there is an interest element that you should definitely record for it. You can't not record it because of accruals concept. If there is a loan, you will have to record interest element on it. So you will record that, you will bring it to present value, and that unwinding every year will be recorded as finance cost. But for me, the unwinding is not coming in picture because these bonds are issued on the last day of my accounting year. All I care about is bringing these bonds to present value right now. So 10 million, sorry, 10 million, if I have to bring it to present value, I don't think I need a working also, into 1 divided by 1.08 to the power of 2. This is how I'll have to bring it to present value. Because I will have to show a unwinding, I'll have to show a finance cost. In this fashion, I'll be able to show a unwinding and fast finance cost if I bring it to present value. So I have a 8573.388 as purchase consideration. So this is forming my total purchase consideration. Yeah. Now the non-controlling interest. Anyway, non-controlling interest, they said, is a percentage of net assets. So how much are my net assets? 11 million. But 11 million is the fair value of my net assets. Fair value of net assets is 11 million. They did not include the DTL impact yet. So I will have to first include the DTL impact on the 11 million. So my net assets will now become, okay, now what is the role of net assets? Net assets are supposed to, sorry, this is not going to be on 11 million. It's going to be on the difference. The deferred tax liability is going to be on the difference, on the increase. So 11 minus 9, the increase is 2 million. If you all want, I will write it also. 11 less 9 million on the increase part only. So it's 800. The DTL is 800. So my net assets are coming up to not 11 million, 10 million 200. Not 11 million, 10 million 200. But net assets job is to reduce the purchase consideration and the NCI, like it's a comparison, not reduce, meaning it's a comparison. So I need to have a negative net assets here. Only then I'll be able to do a comparison. So I'm having a negative net assets here. NCI is missing. NCI, they told me, is a percentage of net assets. So if we may recall, we had acquired 50% as far as I recall. So I want NCI as 50% of this. So I don't need a dedicated working for bonds. So I will now already have my goodwill. So 18473 is my goodwill. 18473 is my goodwill. Okay. Now I'll close the question and I want your focus to come here on the spreadsheet. And I'll just repeat what we did. Purchase consideration, cash was already given. We took that. For bonds, we took the bonds, whatever face value they had given. But because they said that it's a 0% coupon bond, issue and redemption, everything is at par. The way we have to record as per accrual is that we'll have to do some finance cost recording. So we'll have to bring it to present value and we'll have to record the cost, the increasing or the unwinding as cost every year in the 2 years period. So we have brought to present value, right? Okay. Now, coming to the NCI net assets. NCI is a proportion of net assets. So I don't know net assets. I don't know NCI. Coming to net assets. Net assets, you have to take fair value only. Fair value was given to me as 11 million. But there was no DTL impact on the increase from the carrying value to the fair value. So I'm taking that increase impact. This is 11 minus 9 into 4%. To be more precise, I'll just change this. It's 11 minus 9 into 4%. Okay. If the bond was at the beginning, then that finance cost had to come in picture and it would have impacted our group retained earnings. And in the balance sheet, it would have increased the liability. Two places. Retained earnings, it would drop, and liability, it would increase. Okay. Now, moving ahead. So now I want your focus to come on this goodwill calculation. Okay. Bring the focus here. Now, the requirement B was very much just calculate goodwill. Using exhibit 1, calculate goodwill. 3 marks are in my pocket already. But I will leverage this working right now. How? I will get all the marks that are there in the pre-populated for this. Okay. In the pre-populated, what is missing? They did not do an acquisition accounting. They did not record it like a subsidiary. So I need to start recording it like a subsidiary. What they said, this is like an investment 25 million. Go check your pre-populated. Is it like an investment 25 million? Yes. So what all corrections you will have to do? See, you can directly go on the pre-populated and start thinking of the corrections, what is required. Or you can form a journal entry first and then do the corrections. It's really up to you. If you're comfortable with doing a journal entry first and you're even fast with it, I'll recommend do journal entry and then go do pre-populated. Some people don't like journal entry. Some people are good directly at pre-populated. They can go and directly do at pre-populated. That's also completely okay. For me, first, cancel investment in subsidiary, right? If I have to do acquisition accounting, cancel investment in subsidiary, it's existing. It's existing. They said that initially Italy was at 25 million, and I can see also. So if I want to cancel investment in subsidiary, debit or credit? Debit or credit? If I'm doing a journal entry, debit or credit? If I want to remove it, if I want to cancel it, credit, right? So credit, 25 million. Okay, first I did that. Then cancel share capital, share premium of subsidiary. That is already cancelled because they never did a consolidation. It does not even exist in the picture. Second adjustment, add goodwill, add NCI. That is missing. They did not do that. So add goodwill, debit goodwill. I already have it. Add NCI. So debit NCI. NCI also calculated. Okay. Then adjust the retained earnings and make it group retained earnings. Adjust retained earnings meaning what? Remove the pre-retained earnings and add post. Pre already does not exist for sure because they did not consolidate it line by line. So it does not exist. And post should not exist because last day acquisition. So nothing to do over there. Now add the line by line items. So what is missing for your, if I go back to the question, what will be missing is PPE. You should have recorded it 7 million. That must have been missing. Debit PPE because line by line they did not add. Inventory must have been missing. Current liability must have been missing.
Inventory is already.
Inventory is not there. Line by line, nothing they added. So it's missing. Okay. 1 second now, dear. 1 second just. So as per the rules, I have tried to factor everything. Now from this formula, if anything is missing, purchase consideration was cash and bonds. Okay. They must see because they recorded, if you recall, they have recorded for the investment as 25,000, which means that the credit like cash is going out and a liability bonds, they must have recorded it to the 10,000 extent. But point is they shouldn't have recorded it to the extent of 10,000. What they should have recorded is only a bond of 8,573. Now what they recorded is a liability of 10,000. Okay. This is the wrong liability recorded. Correct liability was only to the extent of 8,573.388. So when I'm making a correction, I just have to do a correction to the extent of differential, which means I have to remove a liability to this extent. 1426. So I'm going to removing liability means debit. So debit from the bond 1426.61. Hopefully, now I did NCI recording, I did net assets, I didn't do a DTL recording. See, if I go line by line, bonds, I did a check now, NCI, net assets, fair value of net assets done. DTL is what is missing. So DTL is the 800. Ideally, on the debit side and on the credit side, it should match now because I took everything into account pretty much now. Even from a rules perspective, I thought cancel share capital, share premium, cancel investment, add goodwill, add NCI, adjust retained earnings, add line by line assets. From that perspective also I saw, and line by line over your goodwill working also I saw if anything was missed to be accounted, did I account or not? So ideally this should tally. If it's still not tallying, then something we have missed. So it's pretty much tallying only if you see this seems like a rounding off issue, right? This seems like a rounding off issue. It's 32899.6. So there is a difference of point. This is like a rounding off thing more than anything. Okay. So yeah, this is correct. We can just move ahead if to be more precise. I try to identify where that point error or point rounding off is also there. Okay. What we'll do is we'll take the bond as a rounded off figure, then we'll not face this issue. Okay. Yeah. So this should not come then. Meaning if still as a sum, I will also make this as general. So can you see it's tallying, right? It's tallying. So what I will do is exactly what I have over here as debit credit, same adjustment. If I go and do it on my pre-populated, I'm going to get the perfect mark for this. Okay, so I'm going to write exhibit 1. You can write goodwill, you can write exhibit 1, whatever you want, you can write. First was my goodwill calculation. So I'm going to bring goodwill 18,473. Then PP 7,000. Okay, 18,473 goodwill 18,473. Then PPE was 7 million. Sorry. Then inventory was 6 million. And bond reduction is 1427. Inventory is 6 million. And bond reduction is 1427. 1427, yes. Liability increases 2 million and NCS 5,100,000. So liability increases 2 million, current liability to be precise, and NCI is 5,100,000.
Ma'am, in current liability TTL.
One second. Yeah, I'm just going line by line, no dear. So I've not come there. NCS 5,100,000. Investment is a credit 25 million. Credit 25 million. So credit 25 million, investment means cancellation. So I'll have to cancel this out. Now, DTL 800, recognition pending, like how Raghavina also mentioned. So I'm going to just add in the deferred tax 800. Okay. Now I'm going to do a sum of this and just check if these adjustments at an adjustment level, do they match? 6473 and over here. Yeah, they absolutely match, which means my adjustments are correct. Okay. So this is the way you can go about it. Like I said, if you don't want to do it through journal entry manner, directly while you're observing this working, you want to do your cancellations, additions, or whatever, that fashion also you can do, or you can do it in journal entry format also. Now the point is, when you did a goodwill calc 3 mark, this was just 3 mark. Same time, parallelly, you managed to get 1, 2, 3, 4, 5, 6, 7, 8 marks as well. So 3 plus the 8, which you were going to get it at the end, you got it now. Now imagine you would have gone to the second exhibit, solved that, and then come and do the adjustments to pre-populated. Of course, what is there in the goodwill as an adjustment that was to be done, you would have forgotten it. You would again reread the scenario. So you saved your time. You did not reread. You saved the time. Okay. Now going to the next requirement. C. Using Exhibit 2, explain how the provision for damages, construction cost, and grant should have been accounted for in Rome's financial statements for the year ended 31st December 2026. So we have to explain how these 3 items accounted for. 6 marks are there. But if there are any corrections in the pre-populated, same time I will do it. Okay. So I'll pull this also. So this is requirement C now. Sorry, I think I copied the wrong requirement. It's so I'm going to start. They have asked me like 3 things how it's to be accounted for. provision for damages, grant, construction cost, and grant. So I'm going to like try to do it at the sides. So the size of this a little bit. So they have asked us the correct accounting treatment or how do you account for provision for damages, construction cost, and grant. Now let's read the scenario. Details of a provision, construction contracts, and grant relating to Rome's warehouse. On the first day of the account period, there was a fire at Rome's warehouse. An impairment review was carried out on, and the property was correctly written down to the recoverable amount. They did some right exercise on the property, they brought it down. They did a proper impairment exercise on it. However, the fire caused damage to neighboring buildings owned by third parties. Legal proceedings have been commenced against Rome for damages of 5 million. On the basis that it is probable that these damages will be paid out, Rome has capitalized these costs and 5 million accordingly. Then they move to another scenario, which is on constructing of the new warehouse. So first talking about provision because they have specifically asked us for provision. So definitely two, if it's 6 on the lower side, 2 marks are there for each available, right? If there is a damage because of the fire and because you have damaged the properties of the neighboring entities, then the property value has gone down for the neighboring. Sorry, it's not about the property value going down for the neighbor. You have damaged it, and because of that, claim against you, right? They have raised some legal proceedings against you or your entity against Rome. Now, what they have done is one leg they have recorded it as a liability, as a provision, because you have to pay money. So that's right for me. But what they did is a debit asset. They have capitalized it. Is that right? Debit asset, was it right or wrong? Quickly. Debit asset, was it right or wrong?
Wrong.
Yeah. They should not capitalize. Absolutely correct. They should not capitalize. They should not capitalize. Why? Because there is nothing. See, when do you capitalize something? When do you capitalize? As per IS 16, for a property, when would you have capitalized? When you are acquiring a property. So it's the purchase price for that property. All costs incurred in bringing the asset to location and condition. This is not that cost. Or if it's a subsequent amount that you're spending on it, then it has to be something to enhance the asset. It is not even that. It's not even your asset for which you're paying money. It's someone else's asset which is damaged for which you're paying money. So there's nothing that's coming in your books. So debit is what like? If not capitalized, if not asset, debit is what like? It should be treated as an expense. Absolutely correct. It should be treated as an expense in the P&L. So they're wrong in their treatment. They have to correct their treatment and it should be treated as an expense. So we will write this, okay? As per IFRS, a provision is a liability that has arisen due to a past event. This is a legal or a contractual. This can be a legal or a contractual obligation. This can be a legal or a contractual obligation. In order, also in order for a liability to be recognized, or a provision to be recognized, it has to be reliably estimated. As the is a reliable or as there is an estimate of 5 million and and it is probable that this will be paid, Rome is correct. Guys, please, in recording this, as a provision. However, capitalizing the same is incorrect. Capitalization should occur if this was spent to acquire an asset, or it was cost incurred in bringing the asset to location condition. Subsequent, if this was subsequent spending, then it could be capitalized if it had enhanced the asset. The assets do not belong, the assets for which damage is being claimed do not belong to Rome. Therefore, 5 million should have been expensed and not capitalized. And for me, it's very simple that because they have capitalized, I can very easily, quickly go to my pre-populated and put exhibit 2 over here. I know exactly what wrong they have done. It's very clear. They have capitalized, they have put it in the PPE, removed from PPE, and it's an expense item. So record it as a expense and retain earnings. Expense impact and retain earnings. Okay, simple as that. Now, construction cost. So let's deal with the construction cost. Let's see what is there for the construction cost. During the year, Rome had spent 6 million on the construction of a new warehouse. The construction costs were financed through additional borrowings that incurred a finance cost of 400,000. So spent 6 million on constructing a new warehouse and 400,000 on the finance cost. Both costs were written against profit. Both costs were written against profit, which means they treated like an expense. The building will become operational on the first day of the next accounting period. The building is expected to have a useful life of 40 years. Can you all think and tell me that to record the 6 million under construction cost and 400,000 finance cost as an expense in P&L, was this right or wrong accounting treatment? Was this a right or a wrong accounting treatment? Was this a right or a wrong accounting treatment?
It should be capitalized.
It should be capitalized, correct. It's a wrong accounting treatment. Borrowing cost should be capitalized. Also, what you're incurring while the asset is under construction, that's a work in progress. That's your asset under construction. That should also be capitalized. Okay. So let's start forming the answer. As per, or you can quote as per I-16 or no, not quote directly, just write IFRS also. As per IFRS, the cost incurred in bringing the asset to location and condition should be capitalized. Therefore, 6 million spent on constructing the asset should be capitalized. Also, the borrowing costs are costs. Are interest costs incurred on the loan that was used for a qualifying asset. As this is an asset under construction, this would pass the qualifying asset test. Accordingly, this borrowing cost should have also been capitalized and not therefore the current treatment passed is. So our job is 6 million and 400 both have been expensed, you have to capitalize. So go to your spreadsheet and 6 million and 400,000. So plus 6 million 400 should be capitalized. And or if you want, we can separate the impact. I'll write exhibit 2, or we'll write this as provision. And this I'll write as borrowing cost. So I'll write over here 6,400 needs to be capitalized. And as an expense, they were treated in retained earnings. So I have to remove the impact as an expense. So I'll add 6,400 to the retained. Okay, so if you see, whenever I'm doing an adjustment, literally the adjustment is tallying. If you see on the asset side, if I have a negative 5 million, on the liability side also I have a negative 5 million. If I see over here also I have a negative 5 million. If I have a positive 6,400,000 on the liability side, you can see I have a positive 6,400,000 also on the asset. Yes. Okay. They also go on and say that the building is expected to have a useful life of 40 years, and the building will become operational on the. You can throw more light on the accounting that the depreciation should start once it becomes operational using the useful life of 40 years. But because it's just going to be 2 mark, if you want, you can think about the time and you can also stop here. It's up to you. Because it's just 6 mark and 3 things have been asked. I know that whatever I've written is a very easy 2 mark. It's in fact probably touching 3 mark. What I've written for grant, for sure I'm getting a 2 mark. So I need not overwrite. That's why I'm not writing about depreciation. You all want, you all can write though. Okay. Then I'm going to come to the next scenario, which is on the government grants. So then it's saying that Rome applied to the local government for a grant towards the cost of constructing the new warehouse. Guys, mute your mic. Therefore, the current treatment passes in. Okay, fine. So I'm coming to Rome now. Sorry, I'm coming to the government grants now. Rome applied to the local government for a grant towards the cost of constructing the new warehouse. The application was successful. Shortly before the reporting date, Rome received a lawyer's letter from the local government giving a legally binding undertaking that the grant of 4 million will be paid in 1 month's time. Rome had not made any account in this regard. See, he's going to receive a 4 million grant, and this is confirmed because government is giving him guarantee by giving him a written letter, and this happened before the year end. So for him, debit receivable, he for sure knows that he's going to get this amount, because on the government also now there is an obligation. They have given an undertaking, it's like a guarantee. So for government also it's like an obligation. So if before the year end, easily the Rome entity can record a receivable of 4 million. But credit, what will it record? It's a 4 million for the construction of that building. The construction of the building finishes by the year end. So can you all tell me credit, what will come over here? There are two things that can come, and both the things are right. Two things can come. Can you all put in the
deferred income?
Yeah, deferred income. So you will put it under deferred income, and you will keep realizing a little grant income every year in the PNL basis the life of the asset. That is one thing you can do. And second thing, what you can do is that you can reduce the cost of the asset. You can write credit E, you can reduce it against the cost. So both the methods you all know are allowed. There is an undertaking by the government prior to year end of giving the grant money of 4 million in 1 month's time. This means that the grant should be recorded in the balance sheet as a receivable. The grant amount can now be treated in two ways. Reduction against the asset, in which case a reduced depreciation will go in the profit and loss. Second, treat it as treat in two ways: as a deferred income, which is a liability account. Every year, grant income will be in the profit and loss statement based on the useful lives of the asset. So what we'll do is now for the grant, we will make one more column. Now I'm going to show it. I can show it in two ways. Either I show it as a 4 million reduction over here to my value of PPE, and as a receivable. So in other current assets over here. So this receivable is sorted. This is going to be 4 million over here only. The other leg reduction from here, or you want to show it as a deferred. It's up to you. But if you show it as a deferred, remember that there'll be a split under non-current and current liability both. In because it's because within 1 year itself, out of that 4 million, for 1 year you are eligible to receive within 1 year. So to that extent, go in current liability, and remaining should go in non-current liability. So be very careful. So I'm just choosing the more easy treatment to present here, which is treating the grant as a reduction in the asset and as a receivable. You can numerically also give the depreciation impact and what will be the grant impact. Okay. If you want, we can quickly do that also. Assets carrying value will now become to reduction of $6,400,000, right? So 6,400,000 less the 4,000,000. 6,400,000 less 4,000,000. 2.4 million. Therefore, reduce depreciation basis 2.4 million carrying value and 40 years life will be recorded. Okay, so this is it for your grant. Now, if you may realize, guys, that if I come to the requirement at this point, I catered requirement C, and now I have to go for another 12-mark requirement, which is D, using the pre-populated spreadsheet, and to your previous answer, make corrections. But if you realize, we are already done with this. We don't need to touch this 12 marks separately. We are already done with this. Whatever adjustment was required when we were doing that particular exhibit, we have all. So you're done. Now you can do a total column, but I will highly recommend don't do a total column because especially now that you can already see over here, whenever you've passed the adjustment, it was pretty much tallying. What is the point of doing total column now? It's not that you're going to identify any error or mistake also. Exactly every adjustment that you're doing is tallying in itself, right? So it's going to tally definitely. And there are no marks for this total column. All the marks of exhibit 1, this provision, this borrowing cost, and this grant, no marks for total column. So leave it and then go to the other requirements. Don't waste time over here. Okay. So with this, we come to an end of the 30-mark question, which was the group's question. And this is the style which I will highly recommend. Yeah, Raghavina.
Regarding the depreciation you mentioned in that grant, right? That comes for next year only, right?
Yeah, from next year onwards. Correct. From next year onwards. Not from here.
But,
Only from next year when it will become operational.
Yeah, that should be mentioned, right?
If I have mentioned that the depreciation should start from current year, then it's incorrect. But if I did not start, then I'm just stating that how the depreciation will be calculated whenever calculated, right?
Yes.
If you want, will be recorded when the asset becomes operational. That is from next year onwards. Let me just see. Operational. Yeah. You want, you can add these key.
Yes,
okay.
Fine. Ma'am, regarding the consolidation.
Yes.
Consolidated amount, we have to do it, right? Because they have asked in the question, draft a consolidated statement of financial position. So
no, but there are no marks for the total column. So you need not do it. Okay, there are no marks for the total column, so you need not do it.
Ma'am,
yes.
We have to capitalize the borrowing costs and we are showing that in the asset side. So will
Correct.
there be any impact in the liabilities side?
Okay. So I'll clear this for you. The borrowing cost that we are showing 6,400. So this is actually breakup. Six is for whatever we have paid under construction, and 400 is the borrowing cost. What is the liability side impact is that they had treated these both amounts as an expense. So they had treated this as an expense in retained earnings, which means retained earning must have dropped. So I've added it to the retained earnings. This is the impact.
Okay, ma'am.
Okay. All right. So with this, we come to an end to one of these questions. Now I want to go to the second question, which is on ethics. But of course, I'm sure that this was a lot of you know, taking of information, knowledge, practice. So I'm sure most of y'all are saturated to a certain extent. So let's take a 10 minutes break. Let's take a 10 minutes break and let's connect after 10 minutes. Okay. Let's put a stopwatch. So we're going to, which is on ethics now. Please, same question paper, come to question number 2. Use your navigator. It's called Pavana Company. Okay. I'll read the background requirement and then we'll cater them one by one. Please mute your mics, everyone. Manufactures and distributes products throughout the world. It has properties in many different countries and prepares its financial statements in accordance with IFRS accounting standards. The current financial year end is the 31st December 20x9. So it's your calendar year end. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Accounting initiatives describes the initiatives proposed by the trainee accountant to improve profitability. This itself should ring alarms that, oh, some initiatives to just increase profitability of could be compromised, right? Not necessarily every time. Sometimes you can do the right accounting and have the increased profitability by doing the correct accounting. Sometimes wrong accounting was done and then you do the correct accountability, but sometimes just to manipulate also it can happen. Then second is bonuses describes for basis for a bonus payment to a trainee accountant. Lastly, answer the question requirements within the response option provided. Okay, so let's read the requirements now. First, requirement A1. Discuss whether the property meets the definition of investment property in Koina's separate financial statements, Koina's consolidated financial statements, and explain how the changes in fair value should be reflected in the financial statements. And this is worth a 4 mark. Then they're going to say, then they are asking, discuss whether the trainee's assertions regarding useful life of assets are correct or not. So then they're shifting to fresh requirements. I'll just stick to this much and I first cater this one. Okay. So I'm going to quickly take this on my word because it's a discuss rather than calculate. So I'm going to take it on my word. Rather, what I'll do is,
Mama, busy.
guys, mute your mics. I want to take a different question. Control C, Control V, Control C again. Okay, so we have 4 marks, 3 marks, 3 marks, 3 marks, and then a 5 mark, and then 2 marks professional. So 4, 3, 3, 3. Okay, let's go ahead now. We might not need such a big screen because we're just going scenario by scenario. So we can shrink this. Okay, now let's start reading. A trainee member of the accounting department has proposed to Ms. Patel, the head accountant and an ACCA member, a number of initiatives aimed at increasing Pavana Company's profitability for current period. A trainee member of the accounting department proposed Ms. Patel, the head accountant and an ACCA member, a number of initiatives aimed at increasing Pavana Company's profitability for the current period. The trainee is the nephew of Pavana Company's chairman. Already some issue. The trainee profitability increase is a chairman's nephew whose annual bonus based on a reported profit. The initiatives proposed by the trainee accountant are as follows. So the first one we are catering investment property. A property owned by Koina Company, a subsidiary of Pavana Company, should be classified as investment property. The property is rented to Logon, another of Pavana Company's subsidiary company. The trainee accountant argues that by classifying the property as investment property, any gains in the value will be included in profit or loss, but any fall in the fair value will be deferred by including in the other comprehensive income. Now let's understand what is happening. We have Pavana Company, we have Koina Company, who's a subsidiary. Then we have a Lagoon Company. Now there is an investment property under Koina Company, okay? And investment property has been given on lease to Lagoon Company. Now, in the books of Koina Company, the treatment of investment property, if it's being used for rental income purposes, is this right or wrong? Is this right or is this wrong in the books of Koina? My question is for in the books of Koina to treat it like an investment property. In the chat box quickly. To treat it in the books of Koina as an investment property, is this right or wrong? In the chat box, if it is being used for rental purposes. Put it in the chat box, guys, right or wrong? It is right. No, investment property. What is the purpose as per IS 40 investment property held to earn rental or for capital appreciation? If it's been given to another entity of Koina is giving to other entity to earn rental income, then of course it's correct. What is wrong over here? But for P Pavana Company to treat this as an investment property, is this right or wrong? Tell me, for Pavana Company to treat this as investment property, right or wrong? Wrong. It should treat it as what? Quickly, it should treat it as what? Property, plant, and equipment, because for parent, it becomes an owner-occupied property. Why? Because if the Lagoon Company is occupying it, then for Pavana, it's a owner-occupied property from a group's perspective, not for Pavana. When I say Pavana, I mean Pavana Group. Okay? For group, it becomes an owner-occupied property. Yeah. Pavana and its individual books will have no impact because of this investment property. Pavana Group will have an impact that it will have to account for it as an I-16. Now, tell me one more thing. The understanding of the trainee accountee that, oh, okay, if it's an investment property, then you take the gains to PNL and the losses to OCI. Is that right or wrong? To take the gains to PNL, but the losses to OCI, is this right or wrong?
It's
The
wrong.
fall in it's wrong. If it's
It's
investment
wrong.
property, correct. If it's investment property, gain or loss, both are going to PNL. So that understanding is also wrong. So let's just quickly highlight all of this to fetch our quick marks. As far as I remember, this is worth a 4 marks. So let's do this. In the books of Koina Company, the property meets the definition of investment property. As we can see, it is being held to earn rental. Pavana Company's individual books will have no impact because of this. However, Pavana Group, in the group, this cannot be an investment property as it's owner occupied, and therefore should be recorded as property, plant, and equipment. Trainees' assertion on investment property movement is incorrect. Both and losses are recorded in profit and loss and not to OCI. However, as the classification itself changes in group, classification itself is different, not changes, itself is different in group, the movement will also be recorded as per IS 16 and not IS 40. Therefore, loss will be recorded in P&L and gains in OCI unless there is a loss, there is a previous loss that needs to be offset. Then in that case, gain goes to PL. Hence, again, regarding treatment, trainee cannot do any manipulation here. Okay, so they wanted how it should be reflected. The fair value should be reflected in the financial statement, fair value changes, and whether the investment property meets the or not. We clearly did it. Okay, so yeah, you've closed the requirement here. Now the next requirement: discuss whether the trainee's assertions regarding the useful life of assets is correct. Okay, so let's understand what is it that there's. Okay. Of the plant and equipment should be increased from 5 years to 10 years.
Yes.
Use that this will increase the annual profit dramatically as the asset has already been paid for. No one is bothered how much depreciation is charged for the assets. If the useful life estimate is changing from 5 years to 10 years, first of all, as per IFRS, are you allowed to change the useful life of the asset? Is this something disallowed? Is this a allowed change or disallowed? And if it's allowed, then basis what it is. Changing from 5 years to 10 years, is this a allowed change or a disallowed change? Can you change this useful life? Have you all watched IS 8 accounting policies changing in accounting estimates? Yes, you have, right? So it is allowed. It is allowed. It's not wrong. You can do it. Okay. It's not wrong. You can do it. You can reassess the useful life. And if actually there is a change in the useful life, if you can see that the asset is performing better and it's not appreciating basis the past pattern that you had allocated, and if the depreciation needs to if there is also if there is an enhancement in the assets because of which the useful life is increasing, even because of that you can change, right? So it's allowed as per ISA, and in fact it's a prospective treatment, meaning don't give retrospective impact, give prospective impact, meaning depreciation from current year will significantly drop, and from going onwards, from now till going ahead, it will significantly drop. It will almost become half, right? Because your life from 5 years remaining, you're saying now it's 10 years remaining. So depreciation will become half. So of course there is an impact on profit also. But the trainee saying that, oh, this is going to dramatically increase the profit, and to do this for profitability increasing, is this correct or wrong? To do a change in the assets useful life for a profitability increase, is this correct or wrong? Wrong. That is wrong. To do this for profitability increase is wrong. And also he's saying that nobody is going to be bothered because depreciation is charged on assets which is already paid for. Is this correct that nobody cares? Do not people look at the P&L? Do not people look at how the P&L P&L performance is? People
No,
do
it's
look at it,
about
right?
stakeholders.
Yeah, so this is also incorrect, and people do care about how or what figures are recorded in the profit and loss. Okay. So let's say or talk about this. As per IS 8, change in the useful life of the asset is a change in the estimate. This is a allowed change. If there is a change, if there is actually a change in the useful life of asset, as asset could be enhanced, or the wear and tear pattern is better. This is also a prospective change, and the depreciation will drastically reduce, improving the profits. The trainee is correct up to this extent. However, his assertion that this should be done for profitability increase, or it's not he's saying, he's justifying it that this is for profit, this will increase. So that justification is not required, because if it is, if you're eligible for an estimate change in the estimate, then you can do it. However, there is no justification of profitability increase required as the trainee is providing. Okay. Then there is one more thing that he has done incorrect, is that, not incorrect, his assertion. Trainee's assertion that this does not bother the stakeholders, as this is a charge against asset already paid, is incorrect, as depreciation is recorded in P&L, and P&L line items are of interest to the various stakeholders. Okay, so to that extent, he's not correct. Next question. Discuss whether the inventory write-down is a prior period adjustment. So let's read and understand if the inventory write-down is a prior period adjustment. One second. Classifying a large write-down in inventories that occurred in the current period as a prior period adjustment. The trainee argues that the inventories were probably impaired over 12 months ago, in the year ended to 31st March 2028, and therefore it was a mistake in the prior period not to write down the inventories. Now tell me one thing, that if you identify that the inventories have gone in the current year, but your understanding is that this write down must have happened, this damage to the inventory must have happened in the last year, are you allowed then to go and make an adjustment for prior period rather than current year? Are you allowed? Is there any standard that allows that? Is there any standard that allows that? I'll repeat. Let's say your inventory in the year end is 1st January to 31st December. 1st January to 31st December 20x5 has already passed. We are in 20x6. In 20x6, you all did a physical inspection of inventory and you all identified, oh, from 5 million, the inventory has gone down to 2 million, 3 million drop in the inventory. But what you identify is that, oh, this 3 million damage must have been in the current year. Just because you did a evaluation right now, it's not in the current year. Something had happened in the factory last year. So this is actually a damage of last year. So are you allowed to pass this impairment last year? Are you allowed to pass this impairment in the last year?
No, ma'am. It
Okay.
is recorded as a prior period adjustment in the current year.
Okay. 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 So do you all recall IS 10, IS 10, IS policies changes in accounting estimates and errors? Let's say in the last year, as an error, you did not record it. You should have, because impairment if inventory occurred, you should. But let's say as an error, you did not record it. Because of an error, are you allowed a retrospective or no? Because of an error, are you allowed a retrospective treatment? Yes, you are allowed, which means that you can change the comparatives. You can't change the signed financial statements, you can't change that. What you can change is the comparatives and the opening retained earnings you can change. For the prior period adjustment, you can change the opening retained earnings. Okay. Current year P&L will not have any impact. Current year P&L will not have any impact because it's not an expense of current year. So maybe it's actually current year, but he wants to manipulate the books. He's saying, let's not charge this in the current year. Otherwise, the profits of current year will drop. The profit of current year will drop. The profit not retain earnings. So he doesn't want the profit of current year to drop. So if it is manipulation, if it's incorrect. But if it's actually genuinely a last year adjustment, then it's correct. Okay, so we'll put this in words. Inventory write down can be treated as an expense, or rather, let me reframe it. The inventory write down had been identified
available to see later in the recording.
in the current year. However, the adjustment was period. No. However, the adjustment can be of prior period or it can belong to current period. If it belonged to prior period, then if it belonged to prior period and as an error, this was missed to be recorded, then the comparatives and opening retained earnings can be adjusted. However, if this was not, okay, let me just quote as per ISA. However, if this was not a prior period adjustment, then expense should in the current year itself. Let me just mention that if it is treated in the comparative and opening, then it will not impact the P&L of current year. This will not impact the profits of current year. Okay. Therefore, therefore, recording impairment is correct, but the judgment about when the impairment actually occurred will impact the profit and loss of current year or earnings could be impacted. So Kumel, that's what we said. Now we can't charge it to the previous year, but what we can do is, because the books are already signed, what we can do is the comparatives. You know, right, that there are comparatives, meaning current year P&L and balance sheet when we publish, along with that, there is a previous year P&L balance sheet also published. So we can change the comparatives. And we can change the opening retained earnings, right? So that is changed, not the signed financials. But in real world, hardly people do this because you are giving an indication or a signal in the market that is wrong treatment done, right? So that kind of leads to a losing of confidence of people reading the financials. So people hardly adopt this approach. They try to always avoid it. Though this is the right thing. If you have identified an error, you should of course be able to correct it, disclose it, do the right thing for it. But that's hardly done. Yeah, Raghavina, you have a doubt? Please ask.
Ma'am, regarding the comparatives, you said that we should record in the comparatives.
Yes.
Is it compulsory to record it in the comparatives? And how can we record it in the opening retained earnings of the current year?
See, current year retained earnings means last year's P&L has been impacted. So that is being reflected in the opening retained earning. Last year's P&L, you record an expense. Last year's P&L was, let's say, 10 million profit. But you said, I want to record this 2 million drop. So last year's 10 million became 8 million. So in your opening retained earnings, you're showing that flow, right? That last year's impact is sitting over there. The dropped profit in the opening retained earnings.
Then regarding the inventory, what will happen to that?
The
Inventory
inventory also of last year, you should show that last year itself it was dropped. So that dropped inventory impact will also flow to current year, right? In
Yes,
the current year inventory also it will be lowered only, but impact will continue from last year.
it will impact the profit and loss, right? If inventory is lower.
Inventory is low, but inventory did not become low in the current year. No, inventory became low in the last year is what we are saying.
Yeah, ma'am.
Inventory became, yeah. So that's why it will not impact your P&L of current year.
Okay.
Okay, got it.
Yes, ma'am.
Okay. Now, also, they did not mention to us that in which period this write down was identified. Maybe it was identified in the events after the reporting period, the phase that you have, the adjustment period phase. If it's identified there, then literally your financial go and make a change in the financials itself, right? If it is in the adjusting period. So if you all want, you can write more information. But if it's just y'all are thinking what 3 mark and you all don't want to do a lot of writing, you can avoid also. But at least I'll give one liner at least around it so that I'm just on the safe side from a marks perspective. Also, if this was identified in the current year, in the adjusting period, then the financials of previous year are not signed. And therefore, adjustment can still be made directly in the financials of last year. Okay. Now, discuss how the loan notes should be accounted for Pavana company. So let's read now what's the deal with the loan notes. Recognizing a substantial discount on loan notes acquired in the year as income in profit or loss, the loan notes were issued by one of the Pavana company's suppliers. The supplier has been experiencing significant financial difficulty, which explains the deep discount below nominal value on the issue of loan notes. What is the trainee suggesting? Recognize a substantial discount on loan notes acquired in the year as income in the profit or loss. Okay. Now, I want you all to recall your IFRS 9 financial instruments and when you had loan notes as an investment, as a financial asset debt instrument. If there is a discount on the issue, are you allowed to initially in the year one itself record the entire discount? Are you allowed? Are you allowed to record any discount element initially in the first year if it was issued at a discount? No. The way you account for discount is it's hidden in the effective interest rate. It's hidden in the effective interest rate. You have coupon income, you have effective interest rate. Effective interest rate will include your coupon income, it will include your discounts, it will include your premium, everything. So you're not allowed to record any substantial discount as a interest in as a income element in the PNL on initially. It's not like that. It is to be in a pattern, in a amortizing pattern, okay? Using the effective rate. So first, that's wrong. Second, they're saying that one of the Pavana company suppliers. Okay. The supplier had been experiencing significant financial difficulty, which explains the deep discount below nominal value on the issue of loan notes. So if the supplier had issued loan notes, which mean issuing loan notes, meaning they're borrowing money. And if you had lended money, and if the supplier is now facing difficulty and is not able to, probably have good liquidity, what is this an indication of? What is this an indication of? Impairment. This is an impairment, and you will have to accordingly record for what? You will have to record for what?
Loss. P&L.
You'll have to record for an impairment using the expected credit loss model. Yes, you'll have to judge the credit risk, lifetime or year. What you will do? Lifetime expected credit loss allowance or 1 year? What do you think you're going to do? Because they are saying it's lifetime, because they are saying significant financial difficulties. For me, significant financial difficulties is an indicator of lifetime or credit impaired. So I would use lifetime. The solution in the text is giving credit impaired, but for me, till the time I'm not able to see the signs of credit impairment, like they have not given me words that they are breaching on the installments, interest payments, or coupon payments, or anything of that sort, or any sign that they're not paying the others the amount, then I'm not able to say credit impaired. I will say safe and I'll say lifetime of credit loss. Okay. Discuss how loan notes should be accounted by Pavana company. Okay. The trainee accountant is incorrect in suggesting to record a discount element as credit item, as a credit or as income in profit and loss in the year of acquisition. As per IFRS 9, guys, mute your mics, please. Yeah. As per IFRS 9, the effective rate of interest is recorded as interest income in the profit and loss. This effective interest includes discount, coupon, and any premium. Therefore, income is recorded systematically over the life of the bond. Lump sum discount recording. Therefore, will lead to overstatement of P&L in the first year. And understatement in the following years. Of profit in P&L. Secondly, we can see that the vendor or the supplier is facing extreme financial difficulties. This is a sign of the invest in loan notes being impaired. Depending upon the risk is high or whether it's credit impaired, accounting will be done. As risk, in both cases, lifetime of ECL will be recorded. But if risk is high, then interest is recorded on the gross value. And if risk is low, and if it's credit impaired, on the net value. Okay, again, and just keep writing and do it in more details, but we have to also find a way to stop. Yes, what is the doubt here?
Yeah, thank you, Ma. I don't have any doubt. I just want more further clarification on ECL basically. Yeah, I've read the previous recording, but I just needed to be much more sure. So for the ECL, I know we have the 12 month, and if there's increase in significant, I mean, if there's increase in significant or credit risk, then we'll move to lifetime. And if there are obvious circumstance, then we say the credit is actually impaired, which will lead to us looking at it as stage 3. But my question now is on initial recognition of of an asset, right? Are we meant to kind of assess the impairment at 12 months? Then that's 12-month ECL, that's the initial recognition. Then subsequently, when we reassess and we still feel that there's no significant increase in credit risk, are we still meant to reassess the impairment at 12 months? That is my question. If you get what I mean.
You're saying that you have recorded a 12-month ECL, then you reassess again at the year end, and then if the risk is still low, then is there a fresh recording of the ECL?
Yeah, so what I'm saying is when I now reassess at the end of, I mean, when we reassess the financial instruments, that's the financial asset at the end of the year, and we see that there's no increase in credit risk, are we meant to leave the 12 months that we've recognized initially? Are we meant to leave that as at 31st December? I mean, as at the year end of the complaint. That's what I'm saying.
No. So what you'll have to do is, let's say year end one, you reassess the risk was low. You assess the let's say of 1 month, 1 million of a ECL, okay, brought to present value. Some already you have value in the P&L, already in the balance sheet also. As an allowance, you have recorded 1 million negative item against that investment. Okay. Now, at the end of the second year, what you again reassess whether risk is high or low. If the risk is still low, at least you have to do a recalculation again. If risk is low, you know that you record only up to 12 months of ACL. But the flows are going to be different. The cash flows. So whatever is the fresh estimates and whatever is the cash flows for now the coming years, because at year one, when you were standing, let's say you had 3 years of cash flows that you were talking about. At year two, when you're standing, you have 2 years of cash flows that you're talking about. So of course the value will change. Okay, the value of the impairment and the loss allowance will change. Okay,
Okay,
is
okay,
that
okay.
clear?
Thank you. Yes, thank you.
No problem. No problem. Okay, so we're going to move from here now. We're going to move from here. And we finally have the question, the last question over here, that is saying, discuss the ethical issues arising from the scenario which Ms. Patel needs to consider and what actions should she take as a consequence. What ethical issues are arising in the scenario which Ms. Patel needs to consider? Who are we talking about? We're not talking about trainee accounting. We're talking about from the perspective of Ms. Patel. What issues is she facing? She's been asked by the trainee accountant to do 4-5 things to improve profitability. And one second, before I go to requirement 2B, I will also finish reading bonuses this one. After the trainee accountant proposed the initiatives, an email was accidentally circulated around the company stating that if the initiatives were implemented, the trainee would receive 20% of any bonus paid to the chairman. Oh wow, very fiery email. But yeah, anyway. So 5 marks, you have to identify ethical issues and you have to also give the actions. From Miss Patel's perspective, think and tell. If she's being asked to make changes in the or pass certain accounting treatments, if it's correct, fine. But if it's wrong and she's still being asked to pass, what are the kind of ethical issues that she's facing right now? Or what are the ethical issues that has been identified in the scenario? Not about what she's facing also, it's just what has been also identified as an ethical issue in the scenario. You all know you all have your mnemonic
Objectivity.
PICOP. Objectivity. Okay, the person meaning uh, trainee accountant will lose objectivity for passing the right treatment or suggesting the right treatment because the chairman is on top of him, who's the relative, and his bonuses are probably influenced by this, right? So yes, trainee accountant will lose the objectivity. Okay, and that's why trainee accountant is doing this suggestion. Anything else? Anything else that we've identified? You have PICOP. Objectivity also of the head accountant will be in a way hampered because whatever is being suggested is coming from not any ordinary trainee. It's coming from someone who's related to chairman. So that way, yes, objectivity is hampered. Undue influence is there. Professional competence. I can't tell professional competence right now because if this can become a problem of professional competence if the head accountant is not able to identify that this is in line with the IFRS or not in line. In that case, yes, it's so I can say that if he's not able to identify or she's not, then there is a professional competence issue as well.
Ma'am,
integrity, yes, because
is it a intimidation threat or something?
yeah, it is an intimidation threat. It's an integrity issue as well because if one is not able to be honest regarding what you are recording, then yes, it's an integrity threat. So yes, let's quickly jot these ethical issues and then let's start quickly drafting the actions. Ms. Patel's objectivity is hampered to quite an extent because these suggestions on accounting is not coming from an ordinary trainee, but it is coming from someone who is related to the chairman. Therefore, it becomes difficult for Ms. Patel to look at these suggestions without any bias and make changes only if they comply with IFRS. However, now I've identified the issue, I'm also giving the action. However, Ms. Patel should not come under such intimidation, threat, and should be able to communicate this to the other member of boards or to a more senior person like a director trainee is influenced or trainee is motivated to make such suggestions, as the chairman is a relative whose bonus depends on the profitability. It has also been revealed through email that trainees' bonus is also linked to the director's bonus. This again yes, this is a threat of self-interest. This is a threat of self-interest and again objectivity at all levels seems to be hampered because of this. If Ms. Patel is coming under such pressure and doing incorrect accounting, then this is a breach of integrity. However, if this is being done because of lack of knowledge, then this will be a breach of professional competence. In any case, Ms. Patel needs to act, and as suggested earlier, need to inform or take help from senior members. Ms. Patel can also try to guide the trainee accountant with the correct accounting treatment in each of the 4 cases. However, if there is resistance, then follow-on actions will be required. Okay. Any other direct ethical interest that you see or ethical principle that you see is being breached? Yes, Raghavina.
Ma'am, how it comes under self-interest? It's because they should have some financial dependence on that, right? Financially, they must be independent on.
Yeah, there is no. You see, right, that in the exhibit 2, there is a statement which says that the bonus.
Yeah, bonus is a salary to him, right to him, which is being blocked, which is intimidation threat like thing, right? Not
Yes. So of course, the trainee accountant, is he not motivated that he also needs to manipulate the profits for chairman? Because if chairman's bonus is going to be X amount, his is going to be 0.2x of that amount, right? So there is a continuously dependency chain, no? Trainee dependent on chairman, chairman dependent on the profitability. So is this not a self-interest threat? That the idea is that in providing the right accounting treatment, there is a damage of self-interest because you might lose on the bonus element. If in providing the right accounting treatment, there is a chance that you lose the bonus element. So in order to not lose the bonus element, you will manipulate. So is this not self-interest?
okay, ma'am. Another thing is a breach of integrity is here. That's a breach of objectivity, right? That incorrect accounting is objectivity breach, right?
If you're purposely doing incorrect accounting, then it's integrity issue, because integrity means acting dishonestly. So if you're purposely doing it, then it's also integrity as a problem. Objectivity, when you have such when you have objectivity is going to be a problem. For example, when you see over here that when Miss Patel has to make a decision between what is right and wrong, okay, the objectivity is hampered to a certain extent. Why? Because when the suggestions are coming from trainee accountant, and if it was a normal trainee accountant, she could have stopped the trainee accountant. She could easily stop the trainee accountant. She could have easily rectified the trainee accountant. But because the trainee accountant is a relative, the objectivity gets hampered. Relative of whom? Of some key person. So objectivity gets hampered, because then the decision of right and wrong is now related with many things of your own interest in the organization, of your own continuity in the organization, of your own financial perks, right? So that way objectivity will get hampered.
Yes, ma'am, but breach of integrity doesn't happen, right? Integrity in that incorrect
Breach of
accounting.
integrity, breach of integrity is if Miss Patel will come under such pressure and still do incorrect accounting, then she's still acting dishonestly, right? So it's continuity, no?
Okay, ma'am.
You did it because of
Okay, ma'am.
objectivity, ended up with an integrity issue as well.
It's interrelated.
Yeah, there'll be overlaps. Definitely. You'll see that one issue you're highlighting, and in that you will link 2 to 3 breaches.
Okay.
Sharmeen is saying it's overall a lack of professional behavior. From the trainee accountant side, I can say it's a lack of professional behavior issue. But from Ms. Patel, we still don't see what she has done yet on this, right? So maybe we can say if she doesn't act upon it, then yes, it can become a professional behavior issue. Okay, so you're saying that we are giving out the loan, so a discount on that would be a expense, right? Okay. No. See, I'll tell you what. Shamal, when you're giving a loan, you are on the paper, the face value of the loan is 10 million. If discount to 1 million is recorded, then what you're doing is you're spending, or rather you're just granting or giving only 9 million, but on paper it's recorded as 10 million. So that discount, is it not like a gain for you? Because you're giving only 9 million, but getting recorded as you gave 10 million. So is that not like a gain for you? Shamal. So that discount element is not an expense, it's a gain only. Shamal, did you understand? You are the loan giver. You are the loan giver. You are going to give 10 million. In the face value or the nominal value of the loan is recorded as 10 million. But because of the discount element, you don't have to give 10 million. You have to just give 9 million. On paper, it's recorded as a 10 million loan, which means when the opposite party will return you your loan amount, they will return 10 million to you, not 9 million. So is that discount element not like a gain for you? Why is it like an expense? It's a discount income. We gain that 1 million interest element right now, 1 million, but you're not allowed to record that 1 million in the first year. It has to be spread out over the period of 2 years, 3 years, 4 years, 5 years, till the loan life. So it's incorporated in the effective rate of interest. It's incorporated in the effective rate of interest. If you watch IFRS 9, my FR brought forward knowledge, it's inside that. Okay, no problem. Okay, guys, thank you so much. With this, we come to an end to today's session. What I'm going to do is I'm going to take a screenshot, turn it into a PDF and share it with you all, question number 1 and question number 2. Tomorrow, we'll continue with question number 3 and question number 4. Okay. Thanks everyone again for cooperating during the power outage, during the, link issues. We had too many glitches, but anyway, we sailed through still. Okay. Hoping that tomorrow also we are able to crack both questions and yeah, with lesser glitches. Thank you, everyone. Bye-bye.